Happy New Year, everyone. It
Happy
is
New
time
Year.
to start trading 2024. We've had a little bit of a market pullback so far, but man, what an end to 2023. Got to congratulate a lot of you. We have so many traders in the chat room who are hitting stride. The pieces are starting to come together, and it's not just the bullish market, although you should be aware that in a bullish market with a trend of this type of strength, your performance is going to be better than normal, but we've still got a really strong market. So Harry, say hi to everyone and we'll get started.
Happy New Year, you degenerates out there. Welcome. Hope you learn a lot, make some money, have fun. All of that. It should be a great year ahead. Well, let's face it, it should be a great year ahead for some of you. Maybe not so much for others, but either way, we're here and ready to start the year. And I'm my usual non-cynical self.
Well, just a little housekeeping before we get started. I've got two screens that I like to show. One is overlaid and behind the other. The S&P 500 SPY is the screen that you're seeing currently. This is a daily chart. I will typically have it on a 5-minute basis since we're doing this during market hours. We'd like to be able to see what the market is doing. And so this would be the 5-minute chart. And if we're looking at stocks in the right-hand corner, you'll notice what the S&P 500 is doing on a 5-minute basis. So let's do a little market recap. I'm just going to talk about why I'm bullish, why I think the market's going to continue to go higher. And then we'll have Harry kind of chime in with some of his market analysis and where he feels the market's going to go. And then we can start to drill down, take a look at some individual stocks. We'll take a look at the stocks that we highlighted in the last live event and the last recording that I did. And we'll use some of the searches, see if we can find some new prospects today. And as always, we'll try to answer some questions in the YouTube channel chats and also in the OneOption chat room. We are going to be concluding, and right as we do so, we're going to have the FOMC minutes released. I'm not expecting a huge reaction. So let's go into the daily chart of the S&P 500. Let's get our market bearings for the new year. And here we can see really nice, tight pattern. Very few red candles, no retracement to speak of, no dips. And you can see off of the low in October, we ran right through all the major moving averages. The green line that you'll notice on the chart is AVOFQ. I like to start that at the end of the quarter. It syncs up with triple witching, and the market continued to just power higher. And you know, from my videos, asset managers were caught flat-footed, and on these gaps up, they are not able to participate. So they begin bidding more and more aggressively because the dip never comes. And we were within striking distance just last Friday of the all-time high. We were only 30 S&P points away from it. And so now all of a sudden we've got this little dip, this little round of profit taking that comes in to start the year off. Perhaps prices got a little bit too fluffy. The mentality that you'll see is a lot of traders, novices in particular, will look at a move like this and go, it's gone way too far. There's no way the market can continue to rally like this. Well, they will start picking a top in here and they will start shorting. And you'll also have a lot of profit taking because this has been a really nice run for swing traders. So they're going to see this little hiccup in here. They're going to bail out on some of their long positions. And then out of nowhere, I don't know what the catalyst is going to be, but we do have earnings season coming up next week. Whatever that catalyst is, you will see a couple of long green candles. This will turn into a bullish flag formation, and boom, we will make a new, probably all-time high. That's what I'm looking for. But while I'm waiting for that to happen, I'm also mindful that this is a support level, a fairly minor support level, but that's the low from this long red candle. I'd like to see that hold. You can see we're below the AVWAP-Q. So that's my first support level. Around 467.80 was that low right there. And that is also half of this long green candle. So I'd like to see that preserved as well. We can continue to drift lower and then kind of find support. Then after about probably 5 trading days or so, then I'd be looking for some support to come in. If it takes longer than that to materialize, then it tells me that buyers are not as aggressive as I thought they might be. And so that puts you into a little bit more defensive mode. So you're waiting and waiting. So the nature of this dip is going to tell us how aggressive buyers are. And that is currently what we're watching. So you've got longer term swings on the sectors that I have been suggesting over the course of the last 2 months are the defensive consumer stocks. Those have done incredibly well. The financials, the telecoms, the beaten down laggards, healthcare. Those are the stocks that we've been in. And as we start to look at some of those charts a little bit later on, you'll see that they have retained their strength very well. Money is rotating out of tech. So that's my market synopsis. Do not be a top picker in here. Do not be getting aggressively short, thinking that this market is going to roll over. The headlines right now that I'm reading are that bullish sentiment is off the charts, and the China real estate developers are in trouble. And, these are the headlines after a couple of days of selling. So try not to buy into that. Stay focused on the power of this move. Harry, what's your take on the market?
Well, first off, Moderna, I don't want to say I told you also, but I don't own 90,000 shares or something for no reason. So at 111 now, and I'm still holding up over $10 a share on that position at the moment. I also shorted coin earlier today. I'm watching that one. It's very SEC dependent. It's another news driven. Coin's always going to be news driven, but this one in particular right now, whether or not the SEC approves those ETFs. So there's that. What I'd be curious about from anyone who's listening, if you're serious about making this, says you are someone said you are M down from Moderna. I don't know what M down means there, incognito. But I'm up $10 a share on Moderna right now on 90,000 shares. But what I'm curious about is you have the end of the year, and you have your entire year's worth of trades. Now, whether or not you've been keeping a journal, which you absolutely should have, or you have, just get your report off of Ameritrade or wherever platform you're using, you should have at least taken this break to look through those numbers. You should have taken the time to look through them and see, okay, what type of trades did you do well on? I mean, just look at it in a macro approach. I mean, shorting and going long, right? You might find that majority of the time, or your average return on shorting stocks or buying puts or shorting stock or whatever it might be, or put debit spread, you did not do as well as when you went long. Well, that's valuable information for you. That identifies a very clear issue with your trading. All of the issues, if you've traded for the last year, 2023, all of the issues you encountered is in that data. It's all right there. Everything that you experienced, all the trades you made, and let's say you have 200 trades, I had I think 600 trades in the last year. All of that data is there. The average amount of time you held on to a position is there. What you can do the walkaway analysis. If you had held it for 5 minutes longer, an hour longer, 2 hours longer, the end of the day, what would have your result been? All of that analysis is there. And if you did not take the time over this break to look at your past year's performance, you have to start asking yourself, what are you doing? Because this is not only a job or a career, but it's one that gives you results, right? And as a former statistician, I could tell you, the best thing to have is definitive results, right? Because you can't make predictions going forward unless you have historical results. For example, I used to predict opening weekend box office, right? You could do that because there's a history of opening weekend box office, and you look at the numbers before, because they measure levels of awareness, interest, top choice in a movie before it comes out, and you can compare those to historical films and write models that can predict how a movie's going to do based on the numbers, because you have history, right? You can do that with elections to a point. Obviously, polling is faulty, but it's not as faulty as you think. And you can, because there is an election result that you can look at. In stock trading, there is a trading result you can look at. It's very beneficial to you that you have that. Not only is it your P&L, but it's also the types of trades you made. It's also, what setups were most successful. If you were diligent about writing down the setups that you went in, market was strong, you used to put debit spread for this, straight calls for this reason, stock had relative strength, etc. You can start looking what setups were the most likely to be profitable and not profitable. Because with enough information and enough trades, you can then look back and say, okay, I did my best when I was going long on strong stocks using called debit spreads, and the stocks were over X amount of dollars per share, so on. You can start, so next time a trade like that comes along and you have that exact same setup, you can look back and go, okay, 80% of the time last year, I was profitable in these. I may have been profitable only 5% of the time in the rest of the shit I did, but in this setup, 80% of the time I was profitable. Not only does that give you confidence in that trade, but you can also look at why. Why is that particular setup and trade more profitable than other ones you've been using? What about it was more profitable than other setups you've been using? Did you get the market right and the stock right and so on? So all of that is laid out there for you. And again, it's much easier to look at if you use a journal, right? Because you can just run graphs and charts and slice the data and look at it in various different ways and label your trades. But you can also just download your, all of your trades from the last year and take a look through them and label them that way. If you're not putting in that work, then you're still under the delusion that this is something that you can just do by the seat of your pants. And that, again, the results show you that's not true. That doesn't work. So I hope all of you are going to take the time and have taken the time to review your 2023 trades and looked at what was working, what's not working, and made goals for yourself on what to fix and not fix. Because you certainly also have the ability now to go, okay, this is my goal. I want my win rate up to here. I want this up to here. I want to improve on my 2023 stats. And I want to improve on them by this much. And that's another thing you should all be doing.
I will add to that when you are going through your logs, one thing that you should always be mindful of is what was the market backdrop when you took that trade? What were you expecting the market to do? Because oftentimes I'll talk to traders who go through a stretch like this, and then everything goes to shit. And they're like, oh, what happened? I thought I had all this figured out. I was doing so good. And then now I can't seem to find a winning trade. Well, what was the market doing? You had this stiff tailwind working in your favor, and you're oblivious to it. Make sure that you add the market environment to your trade log as well. What did you expect the market to do? Did you get it right? Did you get it wrong? Did that impact your performance? And when Harry was talking about the different types of strategies that you can be using, there are different parts of the market where you can say, okay, we're in a compression right in here. So this is not when I want to be out there doing short-term call debit spreads that expire in a week, unless you have a stock that's got super great technical breakouts on heavy volume that looks like that momentum is going to go. You can't count on the market in here. But as soon as you get that compression breakout, okay, right in here, I'm going to have a really strong market tailwind. And this is where I can start to consider it because we're through this horizontal resistance. The other point that I want to make about working hard, which is really the point that Harry was trying to make, is this is hard work. When you get into an environment, if you're a novice, I've been suggesting during this pullback, you should be in a long only mindset. If you agree with my market opinion that this is going to turn into a bullish flag, you'll only get into trouble if you are taking short positions, because when this bounce happens, it's going to be violent. And it's going to be a big, giant, long green candle. You're going to get a lot of short covering from the people who are here speculating that the market's going to roll over. So the point I'm getting to is that, okay, I've got 2 days where there's a lull. If I'm in a long only situation, I've got the market continuing to drift lower. That does not mean that I go into a chat room and start posting a bunch of BS, or, I have the TV on in the background and I'm kind of watching a bowl game or whatever it is. You need to be out there setting alerts. That doesn't mean you sit by right now idly. You go and you find the stocks that during this market decline are holding up relatively well, or that might even be breaking through a technical resistance level. Very stealth, very quietly. I have one that I'm going to show you in a few minutes. Those are the stocks that you want to be out there setting alerts on, because when you finally do get that market support and you get that market rally, you're not going to be fumbling around trying to find the next good trade. Your alerts are going to be popping, and you're going to know instantly which stocks are presenting an opportunity to you. So make sure that you're always working. So let me dovetail very quickly into a stock that I found just a few minutes ago. I was kind of surfing around, and this is a good example. Walmart. This is in green royal flush, really like Lily, by the way, also. But we're going to go into Walmart because I saw something interesting. So here we've got this big gap down post earnings before the open. Walmart kind of waffles around into year end. It did have a little bit of strength, but here's what I like technically, is we can see that the stock was able to get above that high price for the day. So we are in that D1 gap. The stock has been able to inch its way above the 50-day moving average. And today, look at it. It is above the 100-day moving average. Well, Pete, you always say that we need to look for heavy volume breakouts and long green candles. Yes, we do. But context, context, context. What has the market been doing when Walmart has been inching its way through the 100-day moving average? The market has been selling off, and Walmart has very quietly been inching its way higher. Okay, when the market finds its footing, this stock is likely to go. So click GTC, click on the top of that bar, and now I have an alert set so that if it gets through the high of the day today, whether it's a week from now or tomorrow, I'm going to get an alert, and I'm going to know that, hey, Walmart has just moved through the 100-day moving average and the market looks pretty decent.
I'm going to look quick here at Lilly today, Eli Lilly. It looks very good. Bit of a choppy stock, but like a nice gap up today. It certainly confirmed over its 50-day SMA. It's a choppy stock, so you have to be pretty close with it, nimble. But it also broke above its trend line. This is the type of stock you do a call debit spread on. You do a 610, 615 call debit spread with expires Friday. You get it for less than $2.50. That's not a bad trade in Eli Lilly.
Yes, I just want to chime in on Eli Lilly. You can see these are the automated 10TL trend lines. Got a nice one dating back here. We have one right here that it's been able to break above. And so now it's going to test that horizontal resistance level. This is, I'd be stretching if I told you this is a bullish flag formation. It's really not, because there's not much of a flagpole here. So the stock hasn't had a lot of momentum. To Harry's point, it's kind of been compressing. If we zoom out, though, we can see this stock has previously had a lot of interest, a lot of institutional buying, and now it is compressing, but it has been able to retain, preserve all of those gains. So over time, as those gains are digested, the bid starts to grow until eventually buyers need to get more and more aggressive, and that's when you get that breakout. So I like it. You can see relative strength. You can see nice volume the last couple of days. Lilly, for sure, I like. So Harry, if I can, I just want to go into Easy Tell this morning, because it was a stock that I had noticed early on. In fact, a number of our members had. So I'm just going to go into a 5-minute chart. We're going to take a look at Lilly. It gapped up. This is very nice. And then it compressed right in here. So what did the market do during that same time period? 5-minute chart of the S&P 500. Market gapped down, and then it continued to drift lower. While it was drifting lower during the first hour of trading, while the market was drifting lower, this stock was inching higher. As soon as the market stopped going down, even in here, whoosh. That's exactly the pattern that we look for.
So there's a trade I like. Quick question here. We're going to maybe go back and forth between stocks and questions. This is covered in the wiki. I'll answer it here. I've answered it before. What's the largest mental hurdle for a trader who takes profits too soon and has too much faith in losers? Well, I'll give you the reason why people do that, and I'll give you a solution. The reason why is because life sucks. That's the short of it. And what do I mean by that is that in your daily life, and I'd say correct me if I'm wrong, but I know I'm not. When something good happens, you're always waiting for the other shoe to drop, right? You know, you get a promotion or you get a raise or something great happen in your relationship or whatever. You're always waiting for, okay, this isn't going to last. Something's going to go wrong. Same mentality when a stock is up. You're waiting for it to drop, right? You're waiting for your profit to be taken away from you. In your life, the reverse is true. When everything is going wrong, you, from God knows where, have faith that things are going to get better. Things are due. Things are going to turn around for you. It's your time. You know, it's got to happen. I mean, hell, this is why people buy lottery tickets, right? Same mentality when a stock goes down. It's going to turn around. It's going to. This will turn around for me. So what you're doing is you're taking your mental lessons in life, which may or may not have served you well, but either way, and you're applying them to your trading. And the market doesn't give a shit about your mental issues of life. So that's where it stems from, right? It stems from you come to trading with that mentality built in, because it's a mentality you live your everyday life with. The solution to that is a very simple thing called the swap trade. Well, the solution to holding on to losers, first of all, is a very simple thing called the swap trade, which is, look, you're holding on to a position, the position is down. And let's say you've got $5,000 in that position. Just take that $5,000 and put it into a better trade, right? Because no matter what, the better trade, your $5,000 is going to have a better chance of working for you than the trade you're in. You're just swapping the trade. You're just closing the trade you're down in, taking the loss, but take that money and put it into another trade that is going to work, or that's more likely to work. Same amount of money, it's just now working better for you, right? So you're mentally, that helps solve the issue of I don't want to take the loss or give up on the trade, because yeah, you took the loss, but that money's still kind of working. And now it's working in a different trade. So let's say you were down 500 in that trade, you took the loss, you swapped it out, you go up 500 in the other trade, you close it out. Now you're even on that rather than staying in the loser. So that's one thing. Two, this idea that people don't like to add to winners is almost mind-boggling, because it's sort of, you now have evidence that you're right, that your thesis was correct, but yet you don't want to double down on that, right? This would be the person at blackjack table that doesn't double down on 11. Well, you made a bet. It might not have been a good bet, but now you got an 11. That's the best. That's a good scenario there. And you go, no, I don't want to double on this, even though my odds have just gone up. When your odds are increasing, when your likelihood to be profitable is increasing, that's when your money should be put to work. Not when it's decreasing, not when it's down. So that's sort of the quick solution to those issues. But as I said, there is a whole write-up on this in the wiki. So there's that.
Yeah, I will add to that personally, it was an awareness of what are my expectations for the market long term. How does the current day's move fit into the context of that longer term market move? And what should I expect out of that position while I have the trade on? So for instance, we go into a market situation now where we have a big rally. I was looking for a big rally. So my positions need to be consistent with that market opinion. And this is where I was advocating buying longer term swing trades, deep in the money calls, 3 to 4 months out, high delta. Why? Because that's my market opinion. And I know I'm going to hit some bumps along the way, but I'm going to let that sucker ride until something changes. Not because I hit a profit target, but because that is my market opinion, and I've spent a lot of time analyzing the market, and until that's proven wrong, I'm going to let that position run. It's the same type of mentality that a scalper gets into in a sideways market. Market sideways, scalp, 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 scalp. All of a sudden you get a bullish trend day. They don't know how to identify a bullish trend day. They don't know that the market's breaking through a major technical resistance level. Oblivious to it. All they know is I'm supposed to set my targets here, so they keep doing the same mechanical thing that they've done instead of recognizing that, hey, this is a bullish trend day. This is the day that I want to ride my positions. So be aware of what the market's doing, what you expect the market to do. And as long as the market and the stock are behaving, you stick with the position and you let it run. So if you had gotten long Lilly in here and you started to see it really soften up and the market is continuing to drift lower right here, okay, then you can take some gains on it. But I have no reason to believe that Lilly is going to go down because it's been riding higher all day when the market has been selling off. So until I see any kind of weakness in Lilly, I stick with the position. I ride it higher. If I get any kind of market bounce in here today, guess what Lilly is going to do? Lilly is going to charge higher, and then I'm going to get the question, how do I ride my winners longer? Why'd you get out of the trade? Harry, how many times we see this every day? Took profits on Merck or whatever the stock is, and we're all like, nice that you took profits, but why?
Yeah,
everything is still working.
How do you keep your position longer? Just don't fucking sell it. How about that? Just don't close the trade. That's how. By the way, here's a interesting one. It might not fit traditional, but I'll tell you why I like it. Microsoft. I'll tell you why I like Microsoft here. If you go to the daily chart on Microsoft and you look at, let's say, November 10th, the bottom of November 10th, and so you draw yourself a L plus trend line. So you, from the bottom of November 10th, you connect to December 4th, connect again to December 14th, almost touches January 2nd. You'll see a nice support level there, right? That support level also coincides and converges with that 50 SMA right there of 365.26. You'll see that support clearly seems to be holding. And now today you have Microsoft with relative strength today. It's now going back above VWAP at the moment. The moment Microsoft gets, I use the 15 EMA on my daily charts. Others use 8 EMA, tomato, tomato. All depends on how long-term you want to look at it. A 15 EMA is a little bit stronger than an 8 EMA and so on. So if you want stronger confirmation, you go 15, 21 EMA. If you want weaker confirmation, but still confirmation, you go to the 8. For me, the moment Microsoft breaks above that 15 EMA on the daily, which comes in at 372.94, so it's about $1 away from it. This becomes a very appealing long for me. And I know a lot of people in the chat room have been doing the Watt AMs on Microsoft, but I think Microsoft seems to went through a couple of days of selling there, and now today with some decent strength with the market down, and now pushing over VWAP. I think Microsoft is shaping up to be a good long.
And that is going to be in a compression, I'm pretty sure. 1.0 squeeze right there. Another way that you can be alerted to this is to set an alert for a compression breakout. You can set an alert here using these highs. I have the alert line ready to go. So as soon as you get that breakout, you're not hunting around for candidates. It's delivered to you on a silver platter.
By the way, if some people are confused, when I say swap, I'm not talking about taking the opposite side of the trade. I'm talking about taking a completely different trade. You know, if you're in, I don't know, Amazon short or long or whatever, I'm not saying you close that and do the opposite of that and go short if you were long. I'm saying go into a trade that makes sense. If your trade isn't working and you're losing on the trade and you're hesitant to close the trade and then just put that money to work in a different trade. Let's say you were short, you were swinging, and then the market reversed, right? It would be to, you know, oh, okay, now I'm going to day trade, particularly if you're day trading, I'm going to go with something that is strong today. You know, I might go into a Microsoft long, for example, and close a short that I had. Obviously, if your short isn't working today, then your short's not going to work. The market is down. So I'm just talking about swapping it into a better trade overall. But I just wanted to point out Microsoft, because it's not one where you look at, you might think, oh, okay, this is going to be a typical type chart. And thank you, Dave, for pointing out Microsoft earnings are on January 23rd. So that should be a note for you to keep in mind, particularly if you're doing any type of put credit spread that goes out farther than that, or you're looking at any type of long-term options. Your premium is going to hold as you go into earnings. You don't want to hold over earnings, but your premium on the options will hold going into earnings if you're up until November 23rd.
Let's take a quick look at the market here. Let's get our bearings, because I'll have it up on the right-hand side. It's a live event, so who knows? Maybe we get something decent to trade off of. I don't suspect that we will. And again, trading is about awareness. Pete, why do you think the market's going to be dead? We got an FOMC minutes release in about an hour and a half. So traders really haven't seen much of anything to latch onto today. We had a little bit of selling. You've got the gap down. When we see long candles, we would like to see them stacked one after the other, like a solo here and a solo there. Not going to mean much. We get this nice long green candle and then almost a bearish engulf that neutralizes it. So we get long red candle and then no follow through. Long red candle, no follow through. We'd rather see red, 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 nice size candles. That is persistent selling pressure. These guys can be reversed very easily. We've got decent volume today. You can see here's the 1OP indicator. We're saying in here, watch out, could get a little bit of selling. That turned out to be nice. Got a little buy signal in here off of the low. Okay, that was decent. Got back to the VWAP. So here's what I'm looking at. Given that I am bullish, I want to see some signs of life here. I want to see some support. We have a low here, higher low, double bottom. We're at VWAP. Still nothing too exciting. These are tiny bodied candles. This is a compression. So there's nothing I'm going to be excited about. There's nothing that's going to excite buyers given the price action we've seen in the last 2 days. They're going to want to see that nice hard bottom, and then they're going to want to see nice stacked green consecutive candles marching higher and filling in some of this gap. If we get it on the FOMC minutes this afternoon, okay, that might be a temporary low that we put in. So for right now, we're just kind of watching to see what happens, expecting that not much is going to happen. And again, awareness. This is important because if you're a day trader, you need to know when you come into the trading day and you start seeing patterns like this and you have an announcement that's going to be released during the trading day, the red flag should be going up. This is going to be a fairly dull trading day. And that's what I'm going to assume until the market tells me different. So that means that I've got to pull back on the number of day trades that I'm doing. And if I am day trading, it means that I need to be more passive with my targets and I need to take them when they're there. This is not a trend day.
No, it's almost, it's not quite a low probability trading environment, but it's pretty damn close to it. The other trade I was looking at is, where was it here? I see a lot of people online today trying to short Tesla. No doubt Tesla's weak, but keep in mind it's Tesla. It is a very volatile stock. Yes, it did just break through the SMA 100 today, which is a good sign if you're bearish and you're wanting to short the stock. However, look how close those SMAs are together. You have the SMA 50 right beneath that and the SMA 200 right beneath that. You have many layers of support here on Tesla. That's several areas that it could bounce. And when you look at an SMA, by the way, and someone asked about how much do I take SMAs into account, I take them very much into account. Why? Because institutions do. They take the 50, 100, and 200 into account, and then some, the 20 somewhat. But institutions take them into account, so I take them into account. If you look at the SMAs, a lot of the times, just because the SMA 50, for example, in Tesla is 234, 03, or 02, oh, that's $6 away. I could still get a lot of downside there if I short Tesla. These things don't always go down and test the SMA exactly. It'll go in and it can approach the SMA and then bounce back up. Look at the daily chart on Tesla. Look how often it came within $2 to $3 of the SMA and then bounced back up. When you have a stock that has a large ATR on it, it doesn't need to go and hit the SMA exactly. It needs to approach it, and then investors can go, okay, support's coming. I'm going to reverse now before, because the ATR is too large enough, before I miss the upside move. And so you have to, with a stock like Tesla, I like to trade Tesla when it is clear of all those SMAs, when it is confirmed bullish or confirmed bearish, below them or above them. When it's hovering around between, that stock is extremely volatile. You get into it, it goes the opposite way, and you can very rarely be comfortable swinging that stock. Now, there was a time a few weeks ago where you could be comfortable swinging it bullishly, but it's so news dependent. You could be very, very positive about that stock, and then the next morning news comes out and bam, you're trapped in the trade. But, a couple of, when you look at when it confirmed on December 15th, that was a good time to be bullish on Tesla, right? It confirmed above its 100 SMA. It was above all of them, and it was moving up. And you would have done well if you held on to that position all the way until 1227 and took your profits. And then, as you see here now, the last 4 days, Tesla has been down on a lot of different news events. So I would just be careful with a stock like Tesla that is bouncing around between SMAs. Trade it when it is clear of those SMAs and you have a confirmation of a bullish or bearish trend, and you have market direction going in your favor. Otherwise, Tesla typically requires a trader to be far too nimble.
Yeah, I agree with that. So we call this blue sky when you get this breakout that Harry was just mentioning on December 14th and 15th. Through all the major moving averages, through the downward sloping trend line. Okay, this stock has a chance to run, and you had a market that was grinding higher. all right, that's a good time if you're going to trade Tesla to take a position in that stock. But I can also tell you during that time frame, there were 100 better stocks than Tesla to trade. And that's another one of those issues that we see with traders a lot of times is I'll see a stock that's posted in the chat room and I'll go, what the heck do they see in this? I mean, there are at least a dozen better stocks that have already been mentioned than this one. I'm going to get to a question. What do I think about Apple 3 years out? I have no clue. I'm a trader. My investment, my trading horizon is typically inside of a month. If I'm looking at Q1, I think the market's going to rally in Q1, but I'm really operating inside that 1 month window because that's where my clarity is. That's where I feel I'm able to best predict what the market is going to be doing. So I focus a lot on day trading. I focus a lot on shorter term swing trades right now. Yes, I might even have some longer term swing trades on that I might have on for a month or 6 weeks or so because of my market opinion. But 3 years out, I couldn't tell you what the competition is going to be or what Apple stock might possibly do.
Someone asked, it's sort of a offhand question, but can I explain quadruple witching? Well, first of all, quadruple, it's really triple witching now. It's not quadruple witching. But what it meant and what it means is it's on a certain day, occurs 4 times a year when it was quadruple. It's the simultaneous expiration of 4 different types of contracts. You got stock index futures, right? So you're looking at, ES futures, things like that. They expire on that date. Stock index options. So, SPY options, QQQ, so on. Stock options, let's say your Tesla calls, whatever, they all expire because it's a Friday. So that the stock options expire every Friday, unless you're a monthly stock option. Every stock option is expiring on Friday. Not every stock, but every Friday stock options are going to be expiring. And then single stock futures, which is the one that really never really took off. And so that's why it's kind of triple witching now, because single stock futures don't really come into it. And what happens is that traders will close, roll over, rebalance their positions. Market makers have to keep up, take the other side. This creates a lot of volatility in the market when you have this many instruments closing at the same time simultaneously. What institutions tend to look at when they're looking at a witching event is they will look at the volume, right? What is the notational value of all of those options expiring? And sometimes the notational value is well into the trillions, which means there's a lot of money that is about to be changing hands, from these options closing. And that will cause the larger the notational value of the entire witching event, the more volatility you'll see. And that volatility tends to ramp up in the final hours of that Friday as these rebalancing and changes begin to occur. So for you as a trader, what it means is basically, you could be trading a market trend. The market could be up. It could be a strong market day. SPY could be doing great. Your longs are doing great, but it's triple witching. The last hour could cause a unexpected red bar drop with heavy volume that could take your positions down. It could just as easily cause the reverse, but now you're talking about a coin flip here, right? So what that is, just to keep in mind, is you're going to have some extra volatility. A lot of people like to put strangles or straddles on during those witching events as well. And I'll share, by the way, with you all, because I get it from JPM, and so I will share it to you. They are suggesting a trade. I don't know how much I agree with it or not, but Costco is reporting their holiday sales tomorrow, and it's an event that typically moves the stock on average around 5%, and the option pricing doesn't quite reflect that. So they're suggesting a straddle on Costco going into Friday. It's not a terrible idea. Straddle's going to cost around $8, $9 for taking both sides of it. You can also probably do a strangle, one out of the money on each side if you want. But they're basically saying the volatility on Costco that's expected from reporting their earnings tomorrow is greater than the volatility that's being priced in on the options currently. That's what JPM is pointing out to me. And so therefore they're suggesting a historically the volatility that's expected is greater than what the options are pricing in for whatever reason. And so that's why they're suggesting a straddle on the position. So I thought I'd share that.
I'm going to take a quick minute and go back over a couple of picks that I made in the last live session that we did. JPM was one of the stocks that I highlighted, and we'll go into that daily chart. I always like to follow up with what we did in the previous videos or the previous live events, because that's the only way that you're going to be able to gauge how well the system performs. And that session was somewhere around December 19th. I know it's been a couple of weeks. So you can see financials have continued to move higher. Really like financials. I emphasize that again when I did my video a week ago. Wednesday, I just did a live recording. I like BAC. I like JPM. I liked Citigroup. I could put all of those up. The charts are very similar for all of them. You can see how they've continued to move higher. This is what relative strength is. Orange line above zero. Just beautiful, beautiful stuff. The other stock that I highlighted has not done very well. It was SNOW. I was a little strained to find something that had decent option implied volatilities, and this stock had continued to drift higher. There's obviously a rotation out of tech. We have this support level right now that's being challenged. It was the 185, 182.50 bullish put spread that we sold for 50 cents, and that was a January 19th expiration. Would I panic right now? Nope. Not even remotely, for two reasons. One is this is a swing trade. This is not something that I have to worry about during the day. I can evaluate that swing trade into the close. If I see the stock get pummeled and close on its low of the day into this gap right in here that I was expecting to be preserved, then I can choose to shut the trade down. But this is all market related. And given that I feel that the market was going to hit a little bit of a soft patch, I'm not worried about it at all, because as soon as the market finds support, I'm expecting the stock to bounce right back. And who knows, maybe that bounce in the market could even come this afternoon on a decent FOMC minute reaction. So no, I'm not going to panic on this. I'm just going to let the trade unwind, and I've still got a couple of weeks left, so I don't need to panic out of the position, but I am expecting the support level to hold. If it cracks down below this support level and it cracks down hard and I have a bearish market, then I've got a backdrop where I can actually leg out of the trade, and I do have videos on that. I'm not going to get into that process now. It's fairly lengthy and it's fairly advanced for most of you. If you have a losing trade, just buy the spread back, or you will compound the problem. Vinny, how high do you expect Microsoft to go when it does break out? That was a question that was posed.
Microsoft, when it breaks out, I expect Microsoft to break above its compression level here, and I would say Microsoft will be at 380 by this time next week. Market. We'll revisit next week and see if it's there, but that's where I'm thinking it's going to break up to. It's a swing. It's a trade I would swing. So that's where I'm liking it right now, and I probably will enter that position pretty soon. And by the way, you know what Pete's doing when he goes back and says, "Okay, let's look at what we suggested last time." You have no idea how key this is. This is why I post every trade, right? I post every trade. I post position size. You can confirm it in time and shares. My position sizes are large enough. They're not hard to find. You can see, oh, yeah, Harry bought 100 contracts at this price. There it is, bam, right there, right? You can see I'm buying what I'm saying buy. Pete's saying, okay, you can look here. Last week we said this, and this is what happened. And the reason that's so important is because trading is plagued. It's one of the biggest problems with people who give advice even though they're not profitable. When you go to college, you have a professor up there, you have a reasonable assumption this person has the knowledge and experience to pass on to you, right? You could check and see the degrees, you could sit there, listen to the lectures. They have some historical backing to standing to be up there and telling you, hey, I know more than you, I'm teaching you here. But everywhere online and everywhere on Reddit are people who give advice on how to trade, even though they don't trade successfully. And it is incumbent on all of you, to say, okay, you're telling me how I should trade. Show me that I should listen to you. Why should I listen to you? Why should I agree with you? Show me that you're profitable. It is not, and I'm not talking about a Photoshop. Oh, I made $1 million last year. Here's my Photoshop P&L. No, show me where you're posting your trades. Show me where you posted or said or put on video, hey, take this trade, and then looking at it a day or two or a week later, see how it worked. Show me proof that you know what you're talking about. Because if someone's going to advise you on how to spend your money, you have a right to know that that person knows what they're talking about. Does that mean Pete or I or any other trader or Dave is going to be 100% correct every single time? No, of course not. It's impossible. And anyone who says they are, they're full of shit. But you have a right to know they're better than you are. They know what they're talking about, and they've proven that they can successfully trade profitably. If they can't do those things, I don't care what they have to say. Now, yes, there are times where someone, I could put out and be like, oh, the 50 had someone be like, that's not the 50, that's the 100 SMA. Or, yeah, those are mistakes. Anybody could point those out. But generally, oh, you should do this, or I like to take out of the money calls for this, or whatever. Show me that works. Don't show me that one trade where you took out of the money puts on the video and you made 100 times your return. Okay, great. Everyone can win a scratch-off ticket or the lottery. Show me you did 100 trades like that, and that method works. That's why we're so stringent in the chat room. I'm so stringent on the forum in Real Day Trading that if something is posted there, you better have proof that it works. You better have proof that over time, consistently, if you did that 1,000 times, your result is going to be X, and that result is going to be a profitable result. Because again, you are trading to make money. You're not trading to trade. You're not trading to brag. You're trading because you want income. You want financial independence. And therefore, you have a right to know that the people who are telling you how to do that have shown that they themselves can do it. So do yourself a favor. Don't listen to anyone that tells you that they know how to trade unless they can prove it.
I had a question on GSK. Is this a good stock? You can see that it's got a nice little breakout here through resistance. This is a pharma company, but longer term, look at this chop. It is in a long-term horizontal range. Yes, it's above the major moving averages, but you can see it had a breakout here. Wow, that was nice. Hey, let's get on board. Flop. Ooh, here we go. We're going to break out this time for sure. Not so fast. This is not the kind of stock. Yes, I would watch this, but it has to prove to me that it is going to go higher. One bar through the horizontal resistance level is not going to be enough. Just like the trust that Harry was talking about, how it's established over time, the stock has to do the same thing for me. I've been fooled too many times with this, looking at this chart. No, I'm not going to bite on this. I'm going to wait to see if that stock is going to continue higher. And by the way, might I be able to find something like this that has performed much better, that I know has institutional interest? But unfortunately, most investors, the mindset is, I can't buy a stock that's run up that much. I've got to find something that's been dogging around for a while, because then I feel like I'm really getting a bargain. Folks, you've got to have momentum. Momentum means that institutions are in there, they're engaged, and they're involved. Okay, so GSK, it's an interesting little breakout. Right now, I like the prospects in LLY a whole lot better.
Yeah, you just have to compare those two charts of GSK with LLY or with Citigroup. I mean, look at Citigroup. I mean, that is a nice, orderly, non-extended. You can look at the EMA, see it's not extended, increase, institutional buying going up, 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 up. When you look at GSK, that is way too choppy. For a day trade, you want to grab 10, 15 cents, grab the momentum, pull, get out of it, and have a quick stop. Okay, fine. But I would not. I would rather take a stock like Lilly or Citigroup if it were me. Someone asked, what do I think about PDD holdings? Let me see here.
You see, I've got my alert line already drawn there. I was just looking at it, so I was like, oh, I'm looking at it. I might as well set my alert.
Yeah, I mean, PDD certainly. Look, I mean, it's been in compression after that big. It's held that gap, which is a good sign. It's been in compression here. It's breaking up out of that compression. Would I like it more above 151? Yeah, but it's not a bad long here. But you can see today, right now, even though it's relatively strong in the first, most of that came from the first half hour of trading. It's just been hanging around VWAP. So I would, if you're looking for an intraday alert, I would look for it to break that compression above VWAP. I'd put an alert somewhere around 150. And if it breaks above 150 today, then you can go. If you want to be more conservative, you put that break at the high of the day.
I will just chime in a little bit here. So we don't have to do extensive fundamental analysis. We're not going to play junior analyst here, but we should know what the hell the company does, what business they're in, what country are they in. Does that pose anything interesting to us? Does that create any kind of issues for us? GSK, that is an ADR. It is not very liquid. So that means that you see a very gappy price action on it. And that's because a lot of the moves are made overnight. That's why you get the gap in here. Guess what? PDD is also foreign stock. That company is in China. So what might I want to do with PDD? Well, you know that we like to trade relative strength. How has PDD fared relative to our market? How has it fared relative to the Chinese market? What the hell is the Chinese market even doing? Do I know? Well, I should know because the stock is going to be influenced by that. So I just put up FXY as an overlay. FXI, down, down, down. Stock relatively strong. If I were wanting some exposure in China and I felt that their market were going to be turning around, which it is not, then I'd want to be in PDD. Obviously, this is a good proxy for the Chinese market from a long standpoint. When their market does recover, yeah, that's a stock you're probably going to want to be in. And should that time come, this little minor resistance level is going to be breached very easily.
Nice pop of a VWAP on SPY here.
Yes, sir. Seeing that, and let's take a look at the market. See there, nice little pop higher here. We are about an hour out from the FOMC minutes. We've had so much Fed speak since the last statement. I'm really not expecting a giant reaction, but when the market is looking to latch on to anything it can, it'll wait for those type of announcements during the middle of the day. I did want to bring up VXX. Harry, the last time you and I did a live event, this thing was starting to finally pop a little bit. And both you and I noticed it just as we were concluding. In fact, I think the last one we did was just before the FOMC statement.
Yep.
I I know that maybe it was a week after, but I know that VXX was starting to pop. And I'm going to try and scroll back and see if I can find that moment, because it was an indication of what was to come. And we did have a decent market drop that afternoon. And I think this is where it started to rise up. So this is on December 20th. And let's go into that December 20th day. And you can see that day finished with a long red candle that came out of nowhere. But the warning signs were there intraday, and they came in the form of that VXX. And by the last 2 hours, we saw a heavy round of selling. But it was a one-off. It was just one day. That's like as much selling pressure as they're able to generate. And there it was. So this is about where we concluded the live event. Started to notice VXX, VIX starting to take off, and then the market sold off. And that was, many are saying that this was zero DTE related. There were some huge put purchases, and that's what caused the market to crack down under light volume conditions. But it was not anything to hit the panic button over, because we've only seen these one-off red candles, and they are instantly reversed. That is a sign of strength.
I certainly hope it does pop. I'd like to get back to selling some puts in here.
Yes, and just outright getting long and watching some of these shorts get squeezed. I'm counting on that, because there are people out there picking tops. I've heard, I don't want to name names, but one of the analysts on CNBC, I happened to be on their website, and he was telling everybody to head for the hills and take profits. A lot of talk about the recession coming up. And like I said, the headlines are about as negative as you can imagine, with one little day of selling. If you listen to the headlines, you're always going to be wrong. These guys are a day late and a dollar short. So the worst thing you can do is to be watching CNBC and going off of what these guys have to tell you.
There. Okay. Let's take a look here. Market's still popping a bit. And by the way, what I mean by that, the puts, selling puts is, if you don't know, obviously, when volatility is high, option prices are artificially, or not artificially, they're inflated because you're taking volatility into account. And that is a good time when you're selling puts, right? Now, the higher the volatility, the more the risk. That's the reason why the prices are higher. But you get more bang for your buck if you're selling puts below a good support level and you're willing to take possession of the stock at that price. You don't want to sell puts when VIX is very low and volatility is very low, and then you're not getting much in terms of premium back on selling your puts. That's a option buying environment when you have low volatility. So, you just have to. A lot of people, they're just buying options or selling options or whatever, and they're not looking at what the average volatility level is on those options, and if they're actually getting a decent return for their choice of investment or their choice of trade. So you really have to put that out there. A lot of momentum stocks, by the way, today, particularly in the biotech sector, that are moving. Just be wary of those. If you're playing momentum stocks, which a lot of you have been brought into trading, learning how, or not, well, I put learning how to trade momentum stocks. It really actually should be the last thing that you're doing, because it's the most difficult type of trade to make when you're doing a very quick momentum trade. The level of experience that it takes to truly be profitable as a good momentum trader is far more than it takes to do the type of foundational trading that we're talking about. So I would not venture into the realm of momentum trading unless you have the core down. But I get it. Look, they can be hard to resist. You know, you see a $10 stock and boom, today now it's up to 13. It's up 30% of the day. It leveled off and now it's starting to go up again. Yeah, I mean, it's cheap. You get shares, you buy at the money calls, and you ride that. Just be very careful with them, and you know when to get out. And those stocks tend to trick you, because what happens is that, you know, let's say you get into stock at 11 and it's got nice momentum and it's going up, and all of a sudden, bam, it drops down to 950 in 2 bars. You're like, shit, should I close? But then you look and you go, oh, okay, well, it had that drop several times today. It rebounded, right? So this is a fast moving stock. So I'm going to stay, because I'm not going to close the position and then the next bar it's going to go up to 13. And that's where it kind of messes with your mind, because it's very hard to depend on a trend, a reversal trend in a momentum stock, because you always think that that dip is going to quickly get bounced back up, because you saw it all throughout the day. Drop, bam, bam, bam. And so every time it drops, you think, bam, it's going to go. But one of those times, and one is all you need, one of those times it's not going to. One of those times it's going to stay down. And, you know, because generally momentum trading isn't steeped in any fundamentals at all, whether it's, you know, institutions or retail traders. It's people who are just buying the momentum. And at a certain point, there's not a buy and hold type situation. And unless there's like some extraordinary news. And again, it takes experience to know the difference between news that's going to stick and news that just gives an artificial pump. But most of the time, that momentum is going to stop when people start taking profit. And usually it just takes one big player to take profit. And then all the dominoes start tumbling down as people start to freak out and go, oh, I'm going to get out now, I'm going to get out now. And down it goes. And one of those times it's not going to bounce back up and you're trapped. So getting trapped in a momentum stock is very easy to do. And you really need to kind of have the experience to know the difference. So that's just my quick take on it. So let's see here. What else do we have going for us today? Oil, Marathon Petroleum. Let me take a look at this here. MPC. MPC. Interesting. Very choppy stock, though. I don't like all the wicks on that chart, but it certainly looks good today. Oil is moving. You know, for oil, I like stocks like Oxy, but right now it's still kind of at its lower SMA. They're like more stable stocks than that. But, you know, keep in mind, if you look at the sectors today, energy is really the only sector that is up today. Everything else is down. Communications is kind of flat, but everything else is kind of down today. Tech is down, consumer cyclical, all of it. Energy is the only sector today that's kind of humming along. So just kind of look into that. We're
kind of flirting with almost the high of the day here, so that's kind of nice. I'll just set a alert here so that we're notified when that happens. I kind of like, for a day trade, RTX has been a really nice stock. And I say day trade because you can see this horizontal resistance level here. You've got this earnings gap on a D1 basis. So you've got this high right here at about 88.69. That happens to coincide with that 100-day moving average, 200-day moving average, pretty dang close. So if I put the crosshair up, you can see how both of these converge pretty closely. So that is a resistance level that it's coming up on, but it's got good relative strength today and it's got good volume. So for me personally, a stock that's been holding up well all day, I get this little dip in here and the stock starts to march higher before the market even does, then yeah, I'm very comfortable buying a breakout like that. And you can see the entire day, the stock has been moving higher when the market has been trading down. But only for day trade, because I'm looking at the longer term D1 chart, I'm seeing some resistance there. So I do not want to swing trade this. It means that I need to be more careful when I enter a day trade too, because I'm not going to be bag holding this day trade gone bad overnight with a major resistance level above. So I'm very selective and I'm very patient, and I don't buy in here. I wait for the dip and I wait for that relative strength to return right in there. Then I can feel comfortable buying it well above VWAP. Nice looking stock for a day trade. Google also grinding higher. I don't like that D1 chart though. There's nothing for me here. Choppy stock back and forth, but it's through a EMA 8. Price action today has been pretty decent. It's got a little bit of volume. So, okay, yeah, I probably could day trade that. Still not my favorite. I still do like that Lily pattern much better. You compare this, higher lows consistently all day long, to even what Google is doing with mixed overlapping candles like this. You should be able to look at both of those charts and know instantly which of those two charts present a better opportunity for you.
Oh, take a look at Merck today, Pete. I mean, Merck is a really nice chart here. Nice pop today, nice confirmation above the SMA. Some pretty good strength, nice institutional buying in there, good relative strength, has all the ingredients you'd want. Kind of like Merck here.
Really nice movement the last 2 days, which it does not typically do either. We can see here that there's got to be some pretty good news to get a move like this out of the stock that normally just chops around. And I believe, yeah, it's been in a pretty steady downtrend for about the last, well, a little bit over a year. This is a nice move here recently. There are definitely institutions out there playing it.
Yeah. That's a stock I'd do straight calls on, as opposed to sort of the call debit spread I mentioned earlier on something like Lilly. Someone asked about coin is up 454 year to date. PE would exceed 100 if you take its revenue as profit. Your first mistake there is trying to look at the fundamentals on a stock like coin. Coin is going to go as crypto goes. Crypto is going to go as regulations go. You know, you need to be careful. For example, a lot of the run up in coin is based on the possibility of an approval for BlackRock and others to do the Bitcoin ETF. And to me, that looks like it is primed for a sell the news event, where, you know, you get that, if you know, it's almost a lose-lose. If the approval doesn't come through, which there was some indications today that it might not, you're going to get a substantial drop there. If it does go through, you have the risk of a sell the news event. So, you know, you only have one scenario where it goes through and it hasn't been baked in by this huge increase over the last couple of months, and it has more to go. So to me, I'm short coin right now, but to me, there's very little at the moment until you see the reaction to that news. There's little to be gained on going long on coin here, but much less to be gained by trying to look at the fundamentals on something like that. That is not a company or a stock that you're going to be looking at fundamentals on at all. Don't forget about the PE ratio on coin. It's all going to be people in coin either think Bitcoin's going to, you know, 200,000 or it doesn't. You know, it's almost a zero something.
Coin bearish engulfing candle off of the high. That is a warning sign for you right there. If you've been riding a stock that's going parabolic like this and you get one of those candles, you should be thinking, I've made a lot of money on this. I should go to the sidelines. Even if I'm bullish on the market, this has been a nice move. And that is unexpected for it to take out those two candles, even when the market was near an all-time high. It was starting to show some weakness. Okay, so make sure that you pick up on those clues. Path was a stock that I highlighted. Somebody asked me about that. Yeah, it's been kind of dogging around. It hasn't done what I'd like to see it do. You can see that it had this nice earnings reaction. It's been compressing. I liked the fact that we were seeing higher lows in here. The last 3 days, it's pulled back, and I would still stick with the position. I'd like to see it regain some of its relative strength. And I would set a GTC alert right in here. I don't want to see it close below this level, and I don't want to see it filling in that gap. So I still would stick with the position. I recognize that this selling here has been market induced. So when the market is soft like that, I'd like to see the stock hold up well. I'd like to see it tread water. I'd like to see it stay near its high. It hasn't. It's pulled back with the market. So I'd hope for better. If I start to see the market rally back up and the stock kind of meanders its way back up, my entry point is somewhere around that $24 price point, and the stock it's really struggling to even get back to that high. I'm going to exit the trade and I'm going to find something better. That was kind of what Harry was talking about earlier with the swap. Why, I don't want to park on a stock that's been doing absolutely nothing and it's starting to show some relative weakness. Why don't I swap into something that looks better, that's moving? And I'm not taking a beating on it. I can exit back at my entry point and still be fine.
Okay. Let's take a look here. Market is now grinding higher off of that nice pop there. Tells me that pop is real. Let's see here what has been moving up during that time. Merck responding well, Lilly responding well. So here you have, you want stocks that were strong, relatively strong, and then when the market pops, continue to be relatively strong. So if you look at Merck and you look at Lilly, you could see no pause there. I mean, it's just continuing to grind higher. All that is a good indication for you that both of those trades are right now, you're safe on either direction the market goes. Lilly was grinding higher when the market was dropping, and Lilly was grinding higher when the market's going up. Lilly is just on its own mission today with institutional buying, and that's what institutional buying or selling, but in this case buying, will do, right? It is, look, the market is going in one direction, the stock is going to another. Someone somewhere or several places, whether it's JPM or Goldman or whatever, are buying and putting buy orders in on that position, which is, those buy orders are going through whether or not the market's retracing. So that's just a good sign for those stocks if you're in them. We pointed them out earlier in this stream. So if you got in there early, that is great. Turnkey trading asks, is it okay to chase trades? Well, I mean, just the vernacular you use, the answer is no, right? You don't want to chase anything generally. The only time is it okay to chase anything. Well, one second here. Just got an update here. Price continues to drive sentiment. Crowded shorts are now down 6% on the year. Market volumes are plus 7%. Activity is very healthy today. Our desk remains better to buy. Echo what we've seen. Yeah, JPM remains very bullish. You have to have a really good reason to chase something. You really need to believe, okay, I missed a better entry. That's the definition of chasing, right? You didn't get in when you wanted to. And so now you're constantly revising upward. And what you're doing is, one, if you are going to chase, put your price slightly above where the price currently is. Because if you keep trying to grab it at the current price, you're going to miss it and it's going to go higher. You're going to try to grab it again, it's going to go higher. So you just put your price with the option or the stock price slightly higher than the price is, guarantee your fill if you're so determined on getting the stock. That stops the chase right off the bat, right? Don't try to get the midpoint or anything if you're getting that type of stock. But in general, you have to believe, and there has to be a reason for your thesis to believe, that this stock is not going to retrace. It's not going to go back down to VWAP. It's not going to lose its strength. It's just going to continue to march higher, right? Would I call Lilly chasing? No, because the difference between chasing and non-trade, Lilly's just as good as a long now as it was an hour ago. it's still a good long. If you look at the chart, everything about it, if I woke up right now and look, oh, I'd go long, blue is a good long. Chasing is generally when you have a momentum stock or a stock that's just drastically dropping or going higher very quickly, and you can't get in because it keeps moving and you want to catch that move. Don't chase moves like that unless, all of a sudden you find out, oh, Tesla just got a contract where Teslas are going to be the official car of the US government or something, and Tesla's going up $5 each, candle. Okay, you could chase something like that because it's substantial news, but you really need news like that that is going to justify that you're jumping in the stock without waiting for it to pull back. So generally, I'd say 99% of the time, the answer is no. And when you're learning trading, don't focus on the exceptions. If 90% of the time even, the answer is no to that question, just don't do it. Don't take the, don't try to grab that 10% of the time that you think is going to be the time you should do it. Leave that to people who are experienced enough to know when that 10% is. But if you are, just learning, go with the odds. If most of the time you shouldn't do something, don't look for the exception. Always go to the rule. And that's another mentality issue that traders have. You're always looking for the exception to the rule. You're always trying to prove to yourself, others, you're smarter than the market. You're trying to counter trade. You're trying to do something that is the 1 out of 10 time is going to work because you can recognize that 1 out of 10 time. The trend is your friend. The rule is the rule. Go with the rules. Don't go with the exceptions. Don't go against the trend. Go with the law of averages. That is how you make money. Don't try to be smarter than the markets, and certainly don't try to be smarter than the institutions and outthink them. They're leaving a trail of very clear breadcrumbs as to what they're doing, whether intraday or daily. Follow those breadcrumbs. Pick up the breadcrumbs. You're not going to get the full meal the institutions are getting. That's why they're the institutions and you are a retail trader. Be happy with the breadcrumbs. You get enough breadcrumbs, you can make a very good life for yourself. Just go with the trend. Piggyback, ride the coattails of institutions up or down. Don't try to beat them. Stop with the damn the man mentality. Instead, the best way to damn the man is to make money off of what they are doing. That is your best revenge there.
Yes, and boy, that's such a big issue for most traders is they just want to chase. They get FOMO. A lot of them are just locked into a stock and it's finally making a move, and now they're even more excited. The biggest bit of advice that I can give you is set alerts. And in Option Stalker Pro, we have them configured so that you can set an alert. Even if a condition is true, by setting these alerts, the condition has to go. So let's say that we get this nice run up yesterday on Verizon, which was a very nice run. Well, you know that this is kind of a stodgy, boring company and that it's sector rotation and you're stacking green candles in here. There's not a big announcement that Verizon made yesterday that's going to impact their bottom line materially. This is sector rotation. What does the company do? My God, if it's a grocery store that's stacking green candles and there's no merger announcement on it, it's not going to go to the moon. It's a boring company. A different tech company with a new product, okay, that might have a chance to really, really run hard. A biotech with a good clinical trial, different story. New AI chip, different story. Could materially impact the company. But a regular company like Verizon, you see it take off, you like the daily chart on it, everything looks good. There's no reason to chase. You right click, bring up your alerts, select the type of alert that you'd like to have. Could be an HA reversal, M5, bullish, great. Set that alert, save it. And now when you get a pullback like this in an HA reversal, there's your flat top red. There's your flat bottom green. You're going to get an alert right in here. And now the stock starts to move higher. This is how you get rid of FOMO. This is how you avoid chasing. So use those alerts. They're really going to help you. If this is something that you struggle with, if you set 10 alerts and you've got 10 super hot stocks that you were really excited to buy, There are probably 8 of them that are going to pull back and give you an opportunity to buy that pullback. But guess what? Out of those 8, 4 of them you might look at and go, this dip is way too deep. Holy cow, that whole move that I was just about to buy completely reversed. Now the stock looks like crap. I don't want to touch it. Broke the VWAP, everything. The other 4 that you see are going to have a nice pullback well above VWAP, start to form a compression, retain their relative strength, regain their relative strength, and then start to move higher. Those are the ones that you want to enter. The alert takes you seconds to place. There's no emotional attachment to the trade. There's no capital that you're chewing up. You can evaluate the size of the dip and then decide if you want to enter the trade, even if the dip was so minor that you had an HA reversal here and the market was pulling back. Cool. Market pulled back. The stock hugged the high of the day. I got my HA reversal. Market looks like it's ready to start bouncing in here. This is the stock that I want to be long. I have all the information that tells me now that it's going to go higher. You don't have that information in here in the first hour of trading. So yes, to Harry's point, you don't want to chase. Even if you've got a gap up market, a gap and go, those are dangerous moves with lots of downside.
And as Pete mentioned, Verizon being a boring stock, that means know the character of the stock. Very easy to do that, by the way, where you can just label them in your journal. Right? This is a news-dependent stock. What are news-dependent? Tesla's a news-dependent stock. NVIDIA is a news-dependent stock. Right? These are stocks that coin, very news-dependent stock. These are stocks that your technical analysis can be bucked by the sudden release of a press release or a news article, right? And they happen frequently. You have stocks that are basically boring stocks that unless there is some significant news, it's going to stay within it. And you can look, or you can look at the ATR on the stock. This stock is going to move 30, 40 cents a day or X percent of its, better to lose percent, X percent of its total share price a day. And it's going to stay in that range. If it goes outside that range, it's usually because there is a reason for it. And if there's not a reason for it, you can not trust that move so much. There are other stocks that are volatile stocks. You can look at their charts. They're very choppy stocks. These stocks are trying to go with the wind. There are retail favorite stocks that institutions tend not to, but a lot of the volume is driven by retail buying and selling. You can tell those stocks too. Know the character of the stock, right? And knowing that and looking at what the type of stock you're in, it's just an extra piece of information. The more pieces of information, you don't want to overload your chart with too much information. Too many people have the charts that just look insane. But you do want to have as much information behind your trade, behind your thesis as possible. And experience will certainly tell you, oh, I know this stock does this, this, and this. But you can speed that process along by simply labeling them in your journals as a certain type of stock. And knowing that could help you with your trade. So you might be less likely to swing a news sensitive stock, for example, right? And you might be more likely to hold for the long term one of those boring stocks that are just on a very nice, consistent, within its ATR though, upward trend. And you know that you're not going to be in for any real big surprises there. You're just going to ride day a day. You're going to make 10, 20 cents on an option or whatever each day, and then close it out. Knowing the character of the stock and the type of stock that you have is also part of it. There are a million little things, obviously, that go into it, and some are more important than others. But knowing the character of stock is just one of those little things that can help you. It's funny when I used to count cards on blackjack on Dave, probably better than I was at. But the whole idea behind doing something like that, and this is relevant here, not that I want to make a gambling analogy, but casinos win because of a very slight advantage, very slight, unless you're a complete moron of a player. The advantage casinos have is like 51.5% over the player. Over time, that 1.5% obviously adds up. the longer you play, the more likely that percentage is going to catch up to you, and the more likely you are to lose. And you're going to lose over time when even a 0.5% is against you. The idea behind counting cards is to move that percentage slightly back into your favor, 52 to 48 your favor, right? 55, 45 if it's like extraordinarily good count. Again, that's not a huge advantage. It's just a slight advantage. In trading, you're looking to get every advantage you can. Is relative strength to SPY a guarantee that your stock's going to do well? No, of course, that's not 100%. It gives you a percentage advantage in the trade. Even if it means when if the market reversed, your trade is buffered and protected, that it's not going to drop or go with the market as much as a stock that doesn't have relative strength would have. Yes, that is a slight advantage you have. You might lose, but you might not have lost as much as you would have if it was a stock without relative strength and the market reversed. And it was just riding the market reverses, stock tanks, right? This case, market reverses and stock kind of stays there, dropping a little bit, but not as much because it has that extra buffer for you. You want to try to grab every percentage point you can in becoming consistently profitable, because you need those extra percentage points. You need them to be consistently profitable. Otherwise, this market will chew you up.
Got a couple of questions here. One is on JPM, and when should I take profits on it? Well, first of all, I'm going to put up the JPM chart. Yes, we like JPM. If you hover over the last candle of JPM, you're going to see that there is an earnings announcement. Actually, I can't see it here for some reason, but there is an earnings announcement. They announced earnings on January 12th, I believe, and that is going to kick off earnings season. So you had better be out of this stock by earnings next week. I don't hold over earnings. Harry does earnings trades. For me personally, I've tried to make money holding over earnings, and it has been a gigantic crapshoot. And if I took a look at all the time and all the effort that I put into analyzing earnings and expected outcomes, and then managing the positions after the earnings announcement and having to deal with that aftermath, I would have been so much better off just trading relative strength and sticking to the system and sticking to a win rate that's in the high 80 percentile versus going out and starting to find an exciting, thrilling earnings play or trying to predict what everybody else on the street is trying to predict. Banks traditionally do not make big reactions to an earnings announcement anyway. So that was one of the questions that came up. Is there a way to see what the option implied volatility is historically? There is within Option Stalker Pro. We need to go into the option pricing, and then we need to select the strike price. And so, for instance, I'll just select the 170 call strike price, and then you can see the stock volatility versus the option implied volatility. We're looking at JPM. You can see the orange line is starting to increase. So these options are picking up option implied volatility where the stock has not been volatile. When you see this separation, this divergence, stock not volatile, option implied volatility increasing, that should be a red flag to you. There is news pending. That would be the earnings announcement next week. When you see high option implied volatilities, they are not there by mistake. They are there on purpose because you have large institutions and market makers who are pricing in uncertainty because they are aware of an upcoming event. Could be earnings announcement, could be litigation. They have people sitting in the courtroom to try and find out what way that verdict is going to go. Could be a clinical trial that's going to be announced. It's their business to know these events. It's their business to get these options priced properly, because if they don't, they won't be in business very long. So yes, there is a way for us to see option implied volatilities within Option Stalker Pro.
Looking here, I find Disney to be an interesting trade right now. Disney has constantly bounced off the 200 SMA here, and it looks relatively strong today. I like the movement on it. I don't mind Disney here. Yeah, I kind of like Disney long at this moment. I don't know how. I mean, you have the convergence here of the 50 and the 200 SMAs pretty much at 89.75. So that's your dead stop right there, right? But it looks strong enough above it. It's getting above its 15 EMA, certainly above its 8, and breaking out of that compression here. It looks to me like a confirmation above those two SMAs, and that those SMAs provided pretty strong support there. So at the moment, I'd be somewhat bullish on Disney.
I think they had some news overnight that they were getting some experts or some funds together to help them evaluate their business model and figure out how to better monetize, blah, blah, blah. It's one of those stocks. I don't even like to trade Disney because every time it looks good, it's like Boeing, you know, it looks good, you get in and then it just falls apart or just doesn't do anything.
Fucking hate that stock, Boeing. And there's a stock that I labeled like spawn of Satan. Fucking hate it. It's one of those stocks, right?
I've talked a little bit about how I have my charts configured. I also have my columns configured so that I've got our buy and sell signals on a 5-minute to a daily basis. I've got real relative strength configured here. I've got the blue dots represent volume on a 15, 30-minute basis and even relative volume. So when I go down the list, the searches are going to help us identify the best stocks just by nature of the search itself and what it's looking for. When I have this visual component to it with all these different variables, now I can pinpoint these stocks in a second. And so I start looking at what looks good across the board. Zim looks good. Okay, we've got this nice horizontal breakout. It's got some resistance here at the 100-day moving average, but with a little bit of room to move up towards it. And that comes into play, actually it's the 200-day around 1290. So there's about 60 cents worth of move in it. Could you day trade it? Sure. And especially earlier today, I mean, that is a nice steady grind higher on heavy volume. Good relative strength, excellent relative strength. So yeah, Zim looks interesting to me. Would I buy it here 20 minutes ahead of announcement? No. I would be in wait and see mode right now.
All right. Pete, I will be right back. My kid's calling me, so I'll be back in a moment. So I'll leave for now.
I had gone through the search and done the same thing on Pop Bull. So we've got outside of the prior day's range. Okay, that's good. Green dot means it's above the prior day's high. I've got nice volume, 15-minute, 30-minute basis. I also have volume that's 2.5 times normal. And I've got green dots across the board. Let's take a look at Juniper. Hey, look at that volume spike. I like it. You can see though the stock was grinding higher, excellent relative strength. Somebody knew something. Yes, I know this is going to come as a shock to all of you, but there is insider trading and insider information. And yes, the SEC tries to nail this down as best they can. And they're obviously looking at high option activity, because if you're going to act on insider trading information, why buy the stock when you can buy call options? So they try and police this as best they can, but I don't know what the news is, but you can see how already earlier today, it was compressing in here, good relative strength, and then boom, big volume. Would I buy it here? Well, in here, if you got in early on these candles, yes, this would be a decent entry point for it. But once you start really stacking long candles like this, now you're chasing. Now you want to see this compress, which it is. You want to see it start to eat away at this long red candle here. It gets above the halfway point with decent relative strength. Yeah, I would try it in here. And let's take a look at the daily chart. Got a compression right here above the 100-day moving average, a nice horizontal breakout through resistance. So yeah, everything looks pretty good. And we've got a breakout previously here. So it breaks out through that horizontal resistance, compresses. So yeah, the stock looks pretty decent. Let's zoom out. Not typically a big mover, kind of choppy. It's a networking company. So temporarily, right now, it looks pretty good. And there is some volume coming into it. So we'll keep an eye on JNPR. That one came up on Pop Bull, which is looking for these compression breakouts.
Someone wrote, so I'm back. In chat room, live event, a couple live event questions here. Do you dislike GS? Clearly a bit sucky today compared to the rest of the financials as a grumble machine, but also looks like it moves and bursts and pretty violently when it breaks out of compression. I'll tell you why I don't like GS right now. You know, you go to a party, right? And everyone's happy, everyone's having fun, and there's just one person there, and they're clearly not. And they're pissed off, and they're in a bad mood. Is that the person you want to go talk to? Right? No, you want to avoid that person, unless that person is usually you, in which case it's a whole separate thing, and that's why no one's talking to you at these events, because nobody wants to, because you're very, very sad. But every other stock, you know, it's not that financials are just going crazy today, but look at that compared to JPM, you know, compared to Citigroup. When you have one kid is not like the other, it doesn't mean you should short GS today, but I certainly wouldn't be going long or looking at it. I would think that's the person at the party I don't want to talk to. Everybody else at that party is having a great time. All the other financial stocks are going, yeah, this is great. Yeah, give me more money. And GS is kind of just sitting in the corner moping. I don't want to go near GS. I don't know if you have a different opinion on Goldman there, but that's mine.
I agree with you wholeheartedly. So if I like the financial sector, I am going to find the fastest horse. And I'm not going to be in a stock that's compressing near its high. I'm going to be in a stock that is making new highs. So yeah, that's kind of what relative strength is. That's what we're trying to do, is we are trading the market, but we are finding the fastest horse. And we're using that stock as a surrogate market position. It's the easiest way to think about this. So I want the strongest stocks, or if I'm short, I want the weakest stocks. I want the stocks that are dropping very quickly if market conditions are bearish. That's our edge.
Someone here wrote, Daisy wrote, Pete and Harry, if I may go back to you speaking about holding winners versus losers, I'm working diligently on adding to winners and actually scaling out of losers at certain levels to combat the opposite mentality. My issue is that I've read many traders scale out of their winners, let her run or on. What are your thoughts on this? You know, it's odd. This is the one mental issue I can't overcome. I don't like to scale out of things. I scale in. And in fact, one of the things I'm doing in 2024 more often is I'm going to start with a lower size trade. So for example, you notice on coin, I normally go 10,000 shares, right? That's my go-to. I'll short or go long 10,000 shares. You notice I only short 5,000 shares, right? Or when I did Lockheed Martin yesterday, I did only 75 contracts. I normally go 100, 150 contracts. My plan is to add to those as they go up and close them if they don't, right? But to build to a larger position more. So I plan on building and scaling up into positions more, or adding to winners more this year. But I, for whatever reason, don't like scaling out of positions, whether they're winners or losers. I'm not saying it's a bad thing to do. It's actually not. It's not a bad thing to do, particularly scale out of winners. You know, you scale out, and a lot of people you have that number where okay, I'm now in profit. I'm taking the trade-off and leaving this on. So anything even if this goes to zero, I'm still in profit. So anything this remainder I keep on is gravy. Fine. That is a perfectly acceptable way to trade. Scaling out of losers, I tend to think that's a little bit more iffy, because if you're scaling out of a losing position, you should just kind of close the position. If there's a reason for you not to have faith in, unless you were oversized to begin with, and you're like, well, I should take a little off here. But for whatever reason, I'm more of an all or nothing person. As you can see, I use up every inch of margin that I have to the brink. I don't like scaling out, but again, that's one of the things that is me personality quirk. It's not, and it hasn't hurt me that much. Probably something I should get better at in terms of scaling out of winners and losers, but I don't do it. Again, not saying it's a bad thing to do. So just putting it out there.
Yeah, I'm kind of a stickler with my entries. I am very, very patient. And when I see an entry, I will usually put a decent sized position on. And if that position is not working in my favor, and I'm seeing the market's going higher, the stock should be going higher, and it's just not doing it, I'll give it as much time as I feel that I need to. But I get, pretty anxious to kind of cut bait and move on to something else that is working for me. If the position is working, then I like scaling in and adding to it and continuing to add to it. And as long as the market's doing what I expect it to do and the stock is doing what I expect it to, I'm going to ride that position. But then as soon as the stock starts to waffle a little bit, or it loses some of its relative strength, then I will actually take profits on the position. I'll take a partial profit on it, let the rest run. Makes it easier for me to manage. I kind of come to terms with the fact that I'm not going to pick the perfect entry. I'm not going to pick the perfect exit. So this is a prudent thing for me to do. And then the remainder of the position that I have on is just, it's a lot easier for me to manage. So different approaches.
Yep. Is GE an okay hold if it keeps above the SMA 20? I entered it on December 27th as a swing. Now it's compressing. It's not exactly compressing, it's dropping. So I wouldn't. I mean, look, if you're telling me, hey, I'm going to hold GE for a year, yeah, sure. If you're going to hold it, it's probably going to get back up to your price point. But you look at it technically, and you look at it dropping below the EMA 15, and you look at it dropping below its compression point right now, I would not hold the long position in GE at the moment. That's just my read on the chart. I don't see any other read on it, but I would not hold the long, particularly if you entered December 27th. You're down probably about $2.50 on the trade. But yeah, I would not hold that position. It's also broken below its L plus trend line as well, so would not hold that.
Yeah, wait till the day is over and evaluate it, see what happens with the FOMC. But yeah, this is a longer term swing. This long green candle right here that opened at 124.23. You wanted to see that hold, and that's where buyers were before. If you break down below it, then you know that they're not there anymore, and the stock has a clean path to continue to go lower. But again, important point made by Harry. When you entered the trade, what was your expectation? How long did you plan on holding this stock? If this is a 6-month trade, then your staying power is going to be a lot greater than if you had gotten into a bad day trade up here, or a very short-term swing trade. Then as soon as it starts to break down below EMA 8 or this compression point in here, I need to, it's not doing what I expected. And in here, your expectation could have very easily been, hey, the market's going to make a new all-time high. This is great. We got 3 days left in the year. I had my pom-poms out. I was cheering for that. I thought we had a shot at it. Didn't happen. Oh, okay. Well, first of all, my market expectations didn't pan out. That's a problem. And then now all of a sudden you start to see weakness in the underlying stock, and the market is starting to pull back a little bit. Okay. That which I expected to happen did not pan out. So yes, mitigate your losses, take some of the risk off, wait for the market to come in, and then you'll be able to reload. So it is important to know when you're in a trade that you need to shut down quicker.
Doug says, I've been trading on and off for almost a decade, tried numerous methods and instruments. How can I stick with something without second guessing? A couple of things here. One, adjust your expectations. It takes, as I've been saying over and over, about 2 years to really learn this. 2 years of hard work before you can start seeing consistent returns. During that time, you should be paper trading till you hit your milestones and then trading one share. So you're not risking a lot of capital. Two, make sure the method is provable. So the methods that you find on Real Day Trading, the methods that I post every single day, Pete posts every single day, Dave will show every single day, those are repeatably profitable methods. How do we know? Because you see them. You see them working year after year, trade after trade. It's statistically impossible for that to be luck, right? I mean, I've had over 600 trades last year. My profit numbers are clear. You can look and see the trades. They're verifiable. You can look, any method you look at, if it's verifiably profitable. So in other words, you see, okay, this is the method. People have been using it. They show me that it works. I see proof that it works, actual proof, not photoshopped anything, actual proof. I see the trades. I can prove the trades are happening. I see the trades work. I see them time and time again over a long course of time. You have to have a large N being large number of a large sample number. So hundreds of trades. All right, it's not working for me. Now you know it's not the method, right? You know the method works. It's not working for you. A, are you doing the method correctly? And B, more likely, it is a mindset issue, right? Again, I go back to poker. It's not difficult to learn the rules of poker. And if knowing the rules alone were enough to make you a successful poker player, you'd all be on, those, playing against Helmuth and all that, but you're not. And the reason is because poker is a mindset game as well. And it's a mental game. You know the rules, but can you play it? And the same thing with trading. You might know the method, or you might have gotten it, but then you some success in the beginning, but then it doesn't work. And you're like, shit, this doesn't work. I'm switching to another one, and you keep switching and switching, and you're not giving it time. And if you find that none of the verifiably provable methods are working for you, you have now narrowed it down to, okay, I have a mindset issue, right? For example, yesterday I went long Lockheed Martin. Lockheed Martin went against me, clearly. I closed it for profit today. Why did I hold it? Because I had no concerns about Lockheed Martin looking at the daily chart. I looked at the daily chart. Lockheed Martin was doing well. I rode Lockheed Martin today. Lockheed Martin was one of the stronger stocks against a weak market. I closed it today because of the fact that we are in a weak market. So I'm taking profits in a stock that had relative strength. I don't know how long that institutional buying is going to last, but I didn't close the trade. A lot of people who know the method would think, oh, well, Lockheed Martin lost relative strength here. The market's weak. I'm closing that trade. I'm taking the loss. And then they would have not had the win today. And it's a lot of little mindset, mental mistakes like that that will make a method that works not work for you. So you have to ask yourself, is it the method or is it your mindset that's not working? Did you give it enough time to work, and is it provable? If it's provable and it's not working, then it's a mindset issue and you need to work on that.
Right. And along the lines with the mindset issue, you and I harp on everyone who's starting out, one share of stock. That's what you start with. And that helps you eliminate the mindset issue. It removes the emotion from the trade. Then you've got a chance to really focus on the methodology and watch the trades play out, see how they perform versus the market, get your confidence level up, get your win rate above 75%. Now, over the course of, say, 3 months, you've been able to achieve that. Now you're getting really fine-tuned with the system. You start increasing the size of your shares, gradually ramping up. That's how you should proceed. But you're not just going to be able to jump into a system and watch some guy on YouTube and then just jump right in and be able to replicate what they're doing. It takes time. So, time and trust. And
I've detailed out for the various mindset issues that you could have, whether it's a gambling mentality, whether it's what I call it uncharmed life mentality. There are a lot of different mindset issues that people have. Most of them are fixable. There are some that aren't fixable, right? And you can almost tell those traders right off the bat. if you come in thinking, you know, the traders are like, oh, I have a way to beat the market, or I know better than this and this, and there's a built-in arrogance without the experience and without the proof backing up that arrogance. It's sort of an arrogance with incompetence, which, you know, coming from the movie industry, I know is a terrible combination. That is very hard to fix. It's very hard to fix someone who can both be incompetent and arrogant at the same time. That's someone with absolutely no self-reflection, no ability. What they're doing most likely is they blame every one of their failures on something else. The market is fixed. It's this, it's that, it's that. The cat ate my homework. The dog did this, whatever. These are people who take no personal responsibility for any failure, and they most likely, without intensive therapy, are never going to. It's almost a waste of time. And the sad thing is most people who have that issue don't recognize it. So they're not like, oh, that's my issue. But as long as you're not one of those, your mindset issue, which I've listed out in the wiki, like 3 or 4 of them that are most prominent, there are fixes to those issues, right? If you have a gambling mindset, one of the fixes is to, part of it is to be able to own up to it. You know when you're gambling and when you're not. You're not kidding yourself. You realize when you do this out of the money put or something, you're hoping on luck or chance, and you're thinking risk reward and all of that. But you know it deep down, this is a gamble. I'm taking a gamble. Then call it that. You'll find that when you call it, particularly if you post it, I'm taking a gamble on this, you'll find it becomes much more harder to do it when you start calling it for what it is. Stop trying to justify it. Stop trying to give yourself all these reasons for why you're making that crazy trade. Actually call it what it is. It's a gamble. The more you do that, the less inclined you're going to be to make those type of trades. So there are fixes. There are things that takes time. It's not something you can start doing right away, but you know, identify what your mindset issue is and work on that issue, because unless you break through that, all method in the world is not going to help you.
Harry, do you want to end with a pick for this session? Is there anything you're really liking here?
I like Merck. I like Merck and I like Lilly. Merck and Lilly would be my 2 picks. I would do calls on Merck or call debit spread on Lilly. I like those 2 stocks. I like the volume. I like the momentum. I like the relative strength. I like the charts. Yeah, all of it. I like those 2. Those are my 2 picks. I like Microsoft still, by the way, but that's not my pick of the day. My picks are Merck and Lilly.
Those look nice. Definitely. Verizon's been one that I was on a couple months ago, way back in here even. CVS was actually one that I highlighted. I can't recall if it was the last live event, so I'm just going to recap it. I'm not going to go there, but this is the compression I liked. Love that breakout there. You can see how that has continued to perform. So still like that stock, but we need something new. We need something fresh, something else that we can latch on to. I know the financials are coming up on earnings next week. PBR, you can see how it's breaking through this horizontal resistance level. I was kind of looking at one of the oil integrateds, CVX, and you can see I've got an alert line here on CVX. I think this might be my pick, but I want to see it through this horizontal resistance level right here. Let's call that 153-ish. If it can get through this, it's got room to get up to the 156 level. This stock tends to trade with very low option implied volatility, so you can get some pretty cheap options. Buy in the money calls if you get that breakout. Earnings not until January 26th. So you want to buy options that expire after 126. Not that we're going to hold them through earnings, but they expire after 126 because they're going to retain their option implied volatility. That would put you into the February 2nd option expiration date. You want to go in the money on them, have that high delta. You can see that the 150 calls, they're trading with a fair amount of premium. The 145s is where you might have to go. Those are in the money by about $7.50. They're trading at about $9.50. So Might even have to go a little bit deeper than that, go into the 140 calls. I'm okay with that. It's just a leveraged stock position, but if it gets through this horizontal resistance, it's going to start filling in some of this gap, and it's got a clean path up to that 156 level. That would be my first target, and you've got time. So yeah, I like what I see in it right now. Energy seems to have a pretty decent bid under it. And take a look at the 5-minute chart, and you can see how the stock is starting to gain some momentum. We've got earnings season coming up right now, which from a swing trading standpoint,
there's your FOMC.
And there's the FOMC coming out here. So you can see that there's a little bit of a reaction to it here. Overall, market, I'm going through, I'm setting alerts. I'm expecting a small dip in here, and I'm expecting that it runs its course this week and next week when earnings announcements start. I'm looking for that bid and that support around the 468 level. And then as we get closer to those tech announcements, I believe we're going to see the next leg higher and a likely bullish flag formation here. That's how I'm trading it. That's my opinion. Perhaps by the next live event, which will be next Wednesday, same time, same place, we'll have a little more information, and we'll start to see some signs of market support. Thanks so much, everyone, for attending. Harry, thank you so much for your insight. We will see you in a week.
Bye-bye.